Around the news, quite a few of you have expressed giving some information on how to trade around the news that we have coming out on a daily basis. Obviously it's a little bit of a different situation than just trading in regular market conditions. So I just wanted to put something together for you quickly so we can take a look at some of the different approaches to trading around news and data events as they occur. First thing, obviously, there's really two types of news events that you're going to come across, right? There's the planned, what I would call planned news events. So those are going to be things that you find on the economic calendar, data we know is going to come out at an exact moment in time. Like US non-farm payroll data at 8:30 on the first Friday of the month, or 8:30 New York time, first Friday of the month. Anything you can find on your economic calendar. Those are news events which we know are going to happen. Then there are also going to be, what I call unplanned news events. And those tend to be headlines coming out during the day, tend to be more from, central bankers, Federal Reserve, ECB, etc., plus, possibly world leaders, politicians. We know someone like President Trump loves to use his Twitter account, can make some headlines, and those headlines can move markets. So we have two very different types of news to be able to trade around. Choosing your event carefully. Now, obviously, some data releases, news events, we know are going to are going to potentially have a major effect on the market. Some not. We know, for example, something like US data have a very broad market effect. It can affect lots of different currency pairs. It can affect commodities. It can affect obviously stock markets, etc. If you dig down maybe into something which has more of a focused effect, and when I say something like that, I'm just picking this at random, but let's say Australian employment data. Now, obviously, that is going to affect anything you may be running involving the Australian dollar. So anything Aussie US, Aussie against Kiwi, against CAD, Swiss, whatever it might be, potentially it's going to have an effect. If you have a dollar yen position, Australian employment data probably isn't really going to have any effect on it. If you have a CAD Swiss position, obviously that's not going to have any effect from Australian employment data either. So you need to be careful what you pick, especially with US data. As I said, it can have a much more of a broad market effect than data which is very specific maybe to a particular country. Positioning in or positioning after. Now, by that, do you run a position into a particular data release? And obviously that would be a planned data release. Or do you try and position after? Now, when you run risk into a certain data release, you are really trying to guess, if you like, unless you have the ability to have access to a particularly high-powered economic model. You're kind of trying to predict two things here. One, you're trying to predict what the data is going to be. That's the first thing. And secondly, and actually more importantly, you're trying to predict what the market's going to do. Okay? And I've sat there in the past, and I worked in the institutional side of the FX business for many, many years. And one thing I used to say was, there were times when even if you told me what the number was going to be, non-farm payroll, take for example, I wouldn't necessarily know how to trade that number, if you like, because I'm not really quite sure how the market's going to react. We have it in our minds how things are going to react, but you also have to remember these days that the initial market reaction is governed a lot less by humans and a lot more by computers. You suddenly see the markets move very, very quickly immediately after a number comes out. That's because all these, the banks and high frequency hedge funds, etc., they all have algorithms that are programmed to react to the data releases as and when they come out in a certain way. And you can get a lot of different reactions, as we've seen in the past. You can get a very quick reaction to where you think it's going to go, and then get a reaction that sort of ends up going the other way. Lots of different things can determine that, but you have to be a bit careful of it. So just be a little bit mindful of that. If you try to position after the data's come out, oftentimes things have moved a lot already, and you have to sort of ask yourself the question, is it worth getting into something now? Let's just say, and I'm just using this as an example, let's just say Australian employment data comes out and it's a really, really positive number, and we see the Aussie dollar suddenly rallies 50, 60, 70 pips against the US. Okay, so it's already rallied maybe as much as 1% on the back of that number after 2 or 3 prices within seconds. And at that point, you kind of have to ask yourself a question, okay, it was a good number, but do I really want to actually get in on the back of it, given the fact it's already moved 1%? There's no right or wrong answer, but you just need to keep that in the back of your mind, because these days things tend to move very, very quickly after data releases. So, just be a little bit mindful of that. If you are trying to get into something, after the data has been released. As far as risk reward is concerned, I always harp on about risk reward, and only be willing to, make more than you're willing to lose on a position. If you're willing to lose $50, at least be willing to make the other side. And certainly when you're trading over news events, it's important to keep that in the back of your mind. And one thing I would say, and I'm going to kind of skip a section here, I'm going to move on to volatility, widening spreads, and pricing gaps. One thing you do kind of have to keep in mind is when you do get a news event, you get a data release, even central banks speaking, planned central bank meetings, and announcing the results of their meetings and policies, etc. You have to expect volatility. You also have to expect pricing gaps as well. So, markets can move very, very quickly, and you have to keep that in the back of your mind, that you almost have to price in what I refer to as slippage. Now, what does slippage mean? If you have a position going into a number, and let's say you leave your stop loss on that position 10, 15 points away from the market, there is a good chance, if that number comes in extreme one way or the other, that the market the price will gap through your stop loss. Okay, even though you set your stop loss 10 or 15 pips away, it may gap 50 points lower immediately, and the first price may be 50 points lower. Now, in terms of how we treat stop losses, a stop loss is a guarantee of execution. If you have a stop, it gets triggered, we guarantee it will get executed and it will get filled, but we do not guarantee the price. Okay, so you will get filled at the next best price available. Now, in normal market conditions, 99 times out of 100, that is going to be very, very close to your stop loss level. But over a news event where there could be a big gap in price, you could get filled a long way away from your stop loss. So you just need to keep that in mind, that can happen. And that's, it's hard to factor in slippage, but it's something you do need to keep in the back of your mind, that if it moves against you, it's something to there. So you need to make sure that when you trade news and stuff like that, you have enough funds in your account in order to be able to hold the position, in terms of margin requirements, etc. And just keep that in the back of your mind, that, any news event that comes out, you can see a very quick gap in pricing. And just, even prior to that, I just, have here on the last point, talking about volatility and widening spreads. Widening spreads is something which is very much a natural market phenomenon prior to a data release. And why does that happen? The simple reason being the vast majority of liquidity coming into the FX markets and any of the symbols you are trading, for that matter, come from tier one banks. They're coming from high frequency hedge funds. It's coming from a lot of different directions. But like us, they know that the market is going to move when the data gets released. So prior to that happening, obviously they don't want to deal on tight spreads at the current market price, knowing that there's a good chance that it's going to move a long way away from that that market point as soon as the data's out. To prevent that, they widen the spreads. And the reason they really widen the spreads is to discourage people from dealing very, very close to the data release. And as I said, that's a perfectly natural market function. There's nothing untoward about doing that. Obviously, they have to practice the banks and the hedge funds, etc. They have to practice sound risk management techniques as much as we do, and that's one way they kind of insulate themselves a little bit, is to widen spreads prior to data getting released. So just keep that in mind. Again, if spreads widen out, you need to make sure that you got enough funding in your account to be able to hold that position, if that's what you're trying to do, over the data release. So keep in mind the widening of spreads. Keep in mind there could be pricing gaps. Keep in mind you could get a lot of volatility around it. And moving on from there, coming to the kind of going back on one point there, but going on to market reaction. And we see over time that market reaction to data is not always as rational as we think it might be. Okay. And, we look at a number, sometimes it comes out, again, I'm going to pick a very, popular number, non-farm payrolls. And we see, the market is expecting an increase in 200,000, which obviously this is recorded right in the middle of the COVID-19 pandemic, probably not the case, but let's just, revert back a couple of months. And we have, let's say the market's expecting that. Now, what you have to remember is these estimates that are put out and you see on your economic calendars, the vast majority of those are the average estimates from economists working maybe at 15, 20 or more so banks, hedge funds, etc. And they basically take the average, and they all have their economic models and everything else. But what you will see from that is those estimates appear, a week, 2 weeks, even 3 weeks ahead of time, based on the economic models that these institutions are using. The institutions themselves put this out to their own internal clients, which tend to be more of institutional corporate nature than retail. So the market's already got in its head that it's going to be around about 200,000. It's already priced in. Now, you and I might sit there and say, well, 200,000 looks like a really good number. And maybe it is, but it's already been priced in. Right? Everyone's got that in their head, but that's what it's supposed to be. So sometimes you'll see something like that, 200,000, maybe the number comes in at 210,000. You think to yourself, well, that's a better number. Maybe, it's a good time to buy dollars or whatever. And then all of a sudden we go the other way. And there's a reason for that. And it's just market positioning. Market positioning is still probably the number one factor behind why things move, simple supply and demand. Now, I'm going to give you a really good example of that. And I'll turn the clock back a little bit here, showing my age. But it's the perfect example. If you go back to the early 90s and the first Gulf War, when everyone was sitting there in every trading room around the world waiting for the US to drop the first Scud missile on Baghdad. And the market for days and weeks knew that this was going to happen. We knew it was going to happen. We knew that war was going to break out. It was just a matter of what day and when it was going to happen. It was so well televised that CNN even had the first Scud landing on Baghdad televised on TV. But the point was, everyone's idea before that was, well, war's about to break out. Traditionally, you buy dollars as a safe haven currency going into a war. And that's what people have done. And leading up to this event, the dollar had associated against pretty much any currency over the prior 2-3 weeks before that, which kind of made sense. The first Scud lands in Baghdad, the dollar rallies 50 points and then drops 500. And the reason for that was plain and simple, is because everyone was overpositioned. Every speculator out there was long dollars. And, other than the first knee-jerk reaction, everyone was running for the exits and there were no bids and the dollar dropped very, very quickly. Now, you would say, well, that's not a particularly rational reaction. Maybe it's not. But because there was so much market position going one way, that's what happened. Now, to a lesser extent, over every data release you get, that can happen. So just be aware of the irrational, if you like, market reaction to a data release, and just be very mindful of that. So hopefully that's just, given my overview of trading news. You just have to be very careful when you are positioning into a planned data release. Make sure that you've got your parameters set. Make sure you allow yourself enough room to hold a position over any widening of spreads and any gaps. Make sure your account is funded sufficiently to be able to do that as well, which is very important. Make sure you do have your risk rewards in place. Think very carefully about how you're trading something, and keep in the back of your mind that you kind of have to factor in maybe a little bit of slippage on your stop losses, because again, that's just a natural market phenomenon. As I said, you got to choose whether you want to run something into a data release or try and position afterwards. As I said, that latter is often difficult, because you kind of got to say to yourself, well, it's already moved. Do I want to try and jump on something that's already moved, or leave it alone? And sometimes the best trades are the ones you don't do. So just keep that in mind. And then obviously you've got my first point there was the planned news against unplanned. The headlines that come out during the day. And I would say here again, oftentimes you'll see markets move because a headline has come out, because President Trump has tweeted something, and unless you're a retail trader sitting there with a Bloomberg terminal at home and seeing all the headlines come out as they come out, oftentimes you'll see something move, and then 5 minutes later you'll find out why. Again, it's already moved. Think carefully about, do I want to jump on that bandwagon now, or has the horse already bolted, and leave it alone? So, just tread with care, and there's great opportunities to trade over news events, because obviously we do know things in general are going to move, but you just need to follow a certain set of rules to make sure that you're aware of the potential pitfalls of so doing, and obviously the potential rewards of so doing as well. And with that, I shall wish you the very best of luck with your thank you for listening, and we look forward to speaking with you soon. Cheers.